talk about hedging strategies. So we're going to talk about different hedging strategies. I've talked about this last week also in part 1 of this. We talked about Bajaj Finance. Today I'm going to talk about Reliance. Okay, so first, it's very important that we need an edge. An edge is telling me what to enter, how to enter, when to enter. Okay, that's my edge. If my edge is not good enough, I'm not going to make a lot of money. I need a good edge. For me, if you've seen, most of my trades are, go in the way that I have, technically analyzed it, and I've realized, hey, this is how this share is going to go. And so for me, my edge is 60, 70, 80, 90% plus. So I'm good with that edge. Okay. But even then, it's very important that you also need to hedge. Hey, if you are 85% correct all the time, why do you need to hedge? Because I'm 15% wrong. So I need to hedge for the 15%. And so it's important that you have an edge. If you don't have an edge, you will never make money. Okay. But you also need to hedge. Okay. Important. Right. So let's look at Reliance. So yesterday I was telling people, hey, look, Reliance has been consolidating nicely. If you remember, at about in the morning itself, I said 9:30, 10 or something. I've said consolidating nicely. Then I told, hey, it's kind of making a small breakout, and I posted this a bit of this. This entire thing wasn't there then. Okay, I just posted the breakout here. So at 1860 was the breakout. So you can see that MACD is above the green histogram. Reliance has gone above the moving average, and it has broken a trend line. When this happened on the 15-minute chart, I bought, I entered Reliance with a call option, 1,800 call option at 97. Now I could have entered with a 1,900 call option. Why I entered with 1,800 was simply because this was the call option I bought on Wednesday and accidentally sold off, or the market sold it off for me. So I was a little upset with 1,800. So I said, okay, if that is what I lost out, because what happened, it went from 82 to about 95, 94, something like that. But the market closed it off for me at about 89. So I was a little upset about it. So I said, 1,800, you failed me the first time. So I'm going to, or you didn't fail, you gave me a profit, but we made a mistake. So 1,800, you're the one I'm going to pick. So I picked the 1,800. The good thing about picking in the money call already is that the delta will be higher and the rate of increase will be kind of similar to a futures. So anyway, I ended that call, and that was at 1:30 p.m. By 3:30 at the close, Reliance had reached 1,920. It closed officially 1,910 or 11. So in 2 hours, the call option had gone from 97 to 139 or 140. Okay. So here's what happened. I made a profit of almost 21,000 rupees. I put about 49,000 rupees into buying that call option. Made a profit of 21,000. A return of 44% in 2 hours. And as you can see, yesterday I made about 72,000 rupees in profit overall. In my futures options trading, including natural gas. Okay, by the way. And Reliance about 21,800. Now I didn't stop there. Now, a couple of things I could have done. I could have sold this off now and say, hey, I made enough money, right? But my expectation is Reliance is probably going to go higher. But at the same time, I want to protect myself. What if this thing goes back down again, right? I don't want to lose out. So what did I do? At the close, at 3:29 p.m., 1 minute before the close of the market, I hedged the position. I sold a 200 Reliance call option at 31.30. It was actually at 32 before, but I didn't sell it then. I could have sold it a little higher. But anyway, 31.30, I sold it off. And so what happens to this position now? Okay, now look at this. This is Reliance, the naked call option of 1,800. You can see if I make, if it closes at 2,000 on 30th July, I'll make a profit of 52,000 rupees. Okay, that sounds really good. All right. But what you don't see is this maximum loss, 48,000 rupees. I could make a loss of 48,000 rupees. There's also a decay that is working against me. If the Reliance gets stuck, Reliance share doesn't move much. Every day I'm sitting with that option call alone, my value is going to keep going down. Okay, and I'll show you this as an example after this using Sensible. Okay, but and the capital required for this was 50,000, right? Now look what happens when I hedge it. Okay, if when I hedge it and it closes at 2000, I will make 67,000. Okay, that is more than 52,000, 15,000 more, right? That's not all. Look at the maximum loss from 48,000. My maximum loss now is 33. Okay, the capital required is 83 compared to 48 before. But look at my break evens. Now, if Reliance keeps going down again, if it goes down again, okay, I will start making a loss if this naked call option reaches, or if Reliance reaches 1,897. Oh, 1,897 is just 13 rupees away, not too close. No, sorry, not too far. But the moment I hedged it, my break even became 1,866. Okay, so then there's the time decay. Time decay on the naked call is about minus 3,000, which means that every day that this call, if Reliance, the price does not move, the value of this call will reduce by 3,000 rupees, or 6 rupees per on lot per day. But because I hedged it, look at this. Here's the funny part. From a negative decay is going to is going to decay by 6 rupees. Now is going to improve by 0.6 rupees every day. I keep holding it. The hedged call. Okay, so there's a lot of benefits by hedging. Now, of course, you have to have a little more margin. When you buy the naked call option, there's no margin required. But when you sell, when you hedge it, of course, you have a margin for the selling call option. But look at this. When I bought just this call, I paid 48,000. The moment I hedged it, they're going to give me money back, about 15,000 rupees back. That is why my premium is only 33,000 here and 48,000 there. Okay, so there is a big, huge difference and power that comes by hedging. I want you to know that. It's very important we know that. Now, let me just go off screen and show you on a practical level how this works. Just so you understand that this is important. All right. Now, you remember NMDC, right? I'm going to show you NMDC. Okay, let me take that. Okay. Now, if you look at NMDC, right, I bought the call option. This is 2 Mondays ago. Okay, I bought the call option for 4.7. I sold the higher call option for 0.9. Now, imagine 20, yeah, 25th, okay, 22nd. Now, look at this. Today, I think NMDC closed at 86.25. So if I were to, now 86.25 today would give me 6,000 rupees profit. But by not doing anything, if I just keep holding it, it's going to reduce, right? You can see it's reducing. That's the decay that comes in with the call. Okay, but here's the thing. That decay is negligible, 670, which means minus 0.1 rupee per day is the decay. I'll just delete this call. Okay. Now look at this. Now you see, oh, 7,700 instead of 6,000, 1,000 rupees more. But look at the decay. It's minus 3,000. And the moment I keep moving this, that thing is going to go by a huge amount. Okay. So the decay is way more when you have a unhedged position. And it is important we hedge it to save our decay. Okay, reduce our decay. Now, another thing. Now, what happens if NMDC closes at, say, 90, right? Profit I can make is 56,000. What happened if I didn't have this? It would have made only 50,000. Okay, so hedging adds more value to your call. Now, let's look at Reliance. Okay, we are looking at Reliance now. The unhedged, this is the call option, that 1,800 call option that I bought, 97 rupees, but unhedged. Imagine the price gets stuck at 1,900. Okay, so 1,900. Today I'm sitting at a now 1,910. Let's go to 1,910. Now this is because already it has lost 3,000 rupees. You can see from the image that I showed, 21,000 rupees, it's already reduced 3,000 rupees simply by close of Friday night to Saturday morning. Simply by one day just getting over, it has lost 3,000 rupees from 21,000 profit, 21,800 rupees profit is gone to 18,900 profit. Okay. Now what happens if I keep moving this? Okay, as the time goes by, it keeps decaying, and my profit keeps going lower. Okay, it keeps going lower. What happens when I hedge it? We're going to go to 1,910. Okay, power of hedging. Look at the profit difference, 4,000 rupees difference, right? This one is 9. Let's keep 18 July. This is also at 18 July. 20,000, 18,000. Let's move this to say 25th July, next Friday. Okay, you have 10,000. It has gone down from 21,000 to 10,000 because the price hasn't moved. There is a decay, very bad. Look at this fellow. Okay, price hasn't moved. Go to 25th July. Can you see that? From 20,000, it has actually gone up in profit. I haven't done anything. See, this is what hedging does. Okay, it reduces a lot of the mental stress when it comes to these positions. Your stop, look at the advantages. Your stop loss has become much lower, right? So your break even, you have increased the chances of you not making a loss. Okay, you've increased the chances of you not making a loss by moving the stop loss further away. Your maximum loss has reduced from 48, it has become 33. Of course, you have to pay more capital, but your maximum profit has also increased. Of course, when it's naked, if this goes to say 21,000, 22,000, you're going to keep making money, obviously, if it's naked. But we don't know. I don't think Reliance is going to go that high, just so you know. Okay, at least before the end of July. But when this guy goes to say 2,100 or 2,000 is when I sold the call option, right? At 2,000, pull it all the way, 67,822. Okay, if it goes anywhere above 2,000. Whereas this guy, if it goes to 2,000, look at this. Okay, let's go to bring it 2,000 and take it to expiry. And if at 2,000, the profit is 52,000. The difference is the 15,000 that I gained by selling the call option. Okay. Now to get 67, Reliance has to go to 2,030 rupees. Possibility is definitely there that Reliance can go to 2,030 rupees. I don't know the likelihood of that within the end of July. But for me to get the same return on this naked option, I have to see Reliance reach 2,030. But for me to realize the same profit on the hedged option, I just had to go to 2,000. After 2,000, of course, but no matter where it goes, I will only get that much money, but I'm okay with that. Okay, I know strategies of increasing this profit later on if I want to, but I'm okay with this. Look, it's so much more easier. There's a lot less struggle. There's a lot less tension. You are actually effectively reducing the loss that you can make, effectively increasing the profit you can make, and all of you guys can see it for life. This is what happens. So I want you to know that this is something that anyone can do, and it doesn't require a lot of science. What it requires a bit of capital. It requires a little bit of wisdom. Okay, people need to understand that you can't simply just blindly buy an option. I'm telling you, people who blindly buy options lose money. People who blindly sell options lose money. People who blindly get into futures, and for that matter, even into normal stocks, blindly will lose money. You need to have good wisdom, good advice, good technical analysis, and you can make money. Just like I showed last week, 13%, 5 days, 1 lakh rupees profit. And I'll give you an example of what I suggest. I suggested this yesterday. I'll show you this example. Okay. Now I told you that I think that the support for Nifty is not going to break 10,550, right? So look at this strategy that I just put up. Okay, 10,550 is the potential support. It probably won't reach there. Okay, 11,350 is probably where it might reach, might not reach. So what I've done is, if I did take this trade up, what I would do is, at before say tomorrow on Monday, what I could do is I would sell a 1,600 put option, and I would buy 10,600 put option. I will sell it. Then I'll buy a 10,400 put option. So those will hedge each other. Then I will sell a 11,300 call option, and I will buy 11,500 call option. Those will hedge each other. If you look at this, the total hedging cost for me, the total margin I would need is about 50,000 rupees, right? Out of 50,000 rupees, I would get 3,700 rupees in my hand. That is my profit if my strategy works. Well, how will this strategy works? As long as it doesn't go below 10,550, and as long as it doesn't go above 11,350, I am profitable. As long as it doesn't go below 10,600, and it doesn't go above 11,300. Basically, the values on these selling put options, okay, a selling put and selling call. If it doesn't go below 10,600, and if it doesn't go above 11,300, I will walk away with 3,731 rupees after putting in 50,000 rupees. Okay, which means I'll get the 50,000 rupees back. Obviously, that's not a. I am not losing that, but I will gain about 7.5% in 9 trading days, with a probability of success of 63%, which is not bad. Okay, and again, I know that the market is more or less bullish. There might be corrections. 11,300 possibility of it crossing is there, but tough. Okay, there's a huge resistance between 11,200 and 11,300. Next, there's a huge support at 10,550. Possibility of it going below 10,600, again, tough. Now, can it happen? Of course, I'm not 100% accurate, but I'm saying that this is a good strategy that someone, if they implement it, doesn't require a lot, and it'll make a good, decent return. 7%, can you imagine? 7% in 9 days. What's wrong with that? Okay, that's a good, decent return. And you're not taking a lot of risk. Okay, so this is why hedging is so powerful, so useful, and why I would suggest people use it. All right. So if you have any further queries, please WhatsApp me, message me on the number that you already have it. Please do subscribe to Kingdom Wealth Creators on YouTube. I want more people to see and understand and learn this. Please encourage your friends, your family to start following. If you know people who are interested in joining with us, please encourage them to do that as well.